Hello and welcome to this video looking at the constraints on development and growth. So in this video we're going to look at a range of different constraints that may prevent a country achieving economic development and economic growth. These are some of the factors that we are going to look through in this video, and we're going to focus on the first 5 here. So one of the main reasons why countries may find it a struggle to grow and develop is because they are dependent on primary sector products for their exports. And this makes them particularly vulnerable to volatile global prices. If the price of oil or the price of wheat crashes, then the revenue they're receiving from their exports also goes down. There's a significant risk here from over-specialization. Many of these countries specialize in primary products, and when the terms of trade moves out of their favor, when the price of their exports decline, then they can experience a lot of difficulty. Often the revenues that are generated from selling primary products are not used productively in the economy to diversify and improve the Human Development Index outcomes. And the result of this is many countries rich in natural resources often have slow rates of growth and poor development scores. Primary products are also of lower value than manufactured goods, so there's no option really for product differentiation, no option for adding value, and so limited scope for increased profits for businesses. Another problem with being dependent on primary products is it can give rise to a phenomenon known as the Dutch disease. And this is a negative impact on an economy that occurs when there is a sharp inflow of foreign currency leading to the currency strengthening. So let's consider an example here. Let's consider a developing country discovers a large oil reserve, and they start to sell this oil. Now, in order to sell this oil, foreign businesses and consumers have to buy our currency, and that in turn drives the value of our currency up. Now, as we know from Spiced, when the value of our currency rises, it makes our exports dearer, so it makes it harder for us to sell everything else. So often the demand for primary products within an economy makes it harder for that economy to sell other products that it's producing. So it becomes self-fulfilling. We become completely specialized on the primary product, and our other sectors in our economy can't survive. This is often known as the Dutch disease. Here are some examples of primary product dependent economies. So at the top here, we have countries like Burkina Faso and Mozambique, very high percentage of people employed in agriculture and very low employment in services. And we can see their HDI ranking, very low HDI ranking, 183rd country in the world, for example. As we drop down the table, we see reductions in employment in agriculture, rising employment in services, and we see the HDI ranking start to improve in general. Here's another example of looking at what countries produce, the percentage of total exports by various categories, the blue being fuels, the light blue ores and metals, diamonds and gold, and then food. And we can see, for example, Angola, 100% of their exports are primary products, the vast majority of which are fuel. Same for Nigeria, their vast oil reserves. In fact, all the countries here, over half their exports are primary products, so they'll all be susceptible to being dependent on those primary products and the problems that can come with that. And one of the big problems is that they are selling, they're price takers. They sell at the global price for these commodities, and these commodity prices tend to be very volatile. So we look at agriculture, energy, metals markets. We look at an index here. We can see big swings, 50% swings in the values of these commodities, which is a huge impact on these economies where all their exports are primary products. One year they might have very high demand, the next year low demand, and so it generates a great deal of uncertainty in these economies. So natural resources, a lot of people would assume that they might be a blessing. 1/3 of the wealth of low-income countries comes from their natural capital, but sometimes they can also be seen as a curse. I also call this the resource curse. That seems to be that economies characterized by high levels of primary product reserves tend to have a lot of economic issues as a result. Another reason why this presents a problem is due to what's known as the Prebisch-Singer hypothesis. Two economists who worked on this, here we go, on the top right. And the Prebisch-Singer hypothesis was as follows, and we should take this down. It says that demand for primary products is often income inelastic. So as we get richer, we don't consume proportionately more primary products. Whereas demand for manufactured goods is often income elastic. As we get richer, our demand for our demand for manufactured goods rises more than proportionately. We want even more manufactured goods. Whereas primary products, I don't want necessarily more gas as I get much richer. So this means that as world incomes rise, as around the world people get richer, the demand for manufactured goods will outpace the demand for primary products. This means that manufactured goods, the price of manufactured goods will rise faster than the prices of primary products. And as a developing country, it means the price of your imports is rising faster than the price of your exports. So the terms of trade is really moving against you. And so this is going to hinder your development. You're not going to be receiving as much for your exports. You won't be able to buy as many imports. And when we look at commodities over time, we can generally see that commodity prices have decreased over time, although since 2000 you might say actually there's been a bit of an upturn. But this would go to support the Prebisch-Singer hypothesis. So what does the hypothesis conclude? It concludes that developing countries should focus on trying to produce their own products, trying to not rely on imports so much, because they're not going to be able to afford them, essentially, as we'd expect the terms of trade to move against them over time. However, we should note that some countries have developed on the basis of primary products. A country may have a comparative advantage in the production of primary products, so resources will be used more efficiently by specializing. As we're maybe seeing now more recently since 2000, primary product prices may also increase as resources become more scarce. Okay, the second reason why countries often find it difficult to develop and grow is to do with low levels of saving and investment. So we need to save money, we need to have savings in order to invest. And so in many smaller low-income countries, there are high levels of poverty, making it almost impossible to save, therefore making it very difficult to provide the funds necessary to fund investment projects. In turn, this may increase reliance on aid. And this problem is often known as the savings gap. So for example, in Africa, Fed saving rates are around 17% GDP, don't compare very favorably to around 30% for middle income countries. In some countries, for example, China, even higher rates. So low savings rates, not having access to funds in poorly developed financial markets in developing countries, so low, not really a banking system that's effective, make it expensive for African public and private sector businesses to get funds for investment. In turn, this impedes capital investment and economic growth. Another model here that illustrates this is known as the Harrod-Domar model. And this emphasizes the role of savings to fund capital investment. And it says that in many lower income countries, gross national saving is insufficient to fund investment, and this therefore has an impact on economic growth and development. So this is what the Harrod-Domar model looks like. We've got two options here. If we take the bottom one in the blue, this is really what's happening in developing countries. So developing countries have low incomes. And if you have a low income, that means in turn that very little saving is going on. And if little saving is going on, there is little money available for businesses and to use to invest. And if there's little investment, we get very low capital accumulation. So we don't get new technologies, we don't get new machineries, don't get new factories. And if we don't get new machineries and new factories and technology, then our incomes stay low. So we can get stuck in this repetitive, self-fulfilling cycle as a developing country. When we contrast that with a developed country at the top, we can see that higher economic growth and greater incomes lead to higher savings. Higher savings means more funds available for investment. Investment means improved and better capital stock, which in turn generates higher economic growth. So we have these feedback cycles that are called the Harrod-Domar model that predicts that if we have low levels of savings, we'll be stuck in this perpetual low development cycle. Our third reason that we're going to look at here is a foreign exchange gap. So many developing countries face a big imbalance between inflows and outflows of foreign currency. A foreign exchange gap happens when currency outflows persistently exceed currency inflows. So for example, if I'm spending more foreign currency buying imports than I'm receiving from selling my exports, I need to source that from somewhere. So we might have a foreign currency gap here from running a current account deficit. Sometimes people remove their money from our economy, known as capital flight, if they're concerned or lacking in confidence about the future. Perhaps if people don't send as much money back from abroad, again, we will see an issue with low levels of foreign exchange. A key consequence of foreign exchange gap is that as a nation, we do not have enough foreign currency to pay for essential imports such as medicines, foodstuff, and raw materials. In turn, this hampers economic growth, reduces economic growth. Closely related to this concept is one of capital flight. So some countries will eventually resort to devaluing their exchange rates in a bid to improve their competitiveness. However, the threat of a currency devaluation might make people in that country nervous that their currency, their savings in their bank accounts, might suddenly lose value. So in order to avoid that, they might move their currency out of the country to another country where the currency has a more stable value. And this is known as capital flight. There could be several reasons for this, normally linked to a lack of confidence in the economy. So maybe if there's political turmoil or war, if there's a fear of nationalisation, maybe uncertainty over the exchange rate and the risk of a possible devaluation, maybe fears of the stability of a country's banking system and the introduction of capital controls. So a lot of money actually leaves Africa each year as a result of low levels of investor confidence. So in this video, we've looked at a range of different constraints to economic growth and development. That's it. Thanks very much for listening.